Okay, hello. My name is Miguel. I'm part of the board of CFA Society Portugal, and I'll be the host of these events. This event is basically a panel. We have three persons that work in portfolio management, and the goal is to discuss what is portfolio management all about. And by learning by the experiences from the experience of our three guests, we'll try to make sure that we understand what portfolio management is, what skills a portfolio manager needs to have to be successful at this job. How can one pursue a career in portfolio management, and what challenges a portfolio manager faces, and so on and so forth. I would like to thank all the attendees, of course, also the 7 affiliated universities for partnering up with us in this event. And I would like to remind that this event was tailor-made thinking about the students. The main goal is to provide information to the students about the profession, so they can think about if they want to pursue a career or not in this field. And of course, a big thanks for all the 3 speakers who managed to find time in their busy agendas to participate in this event. Before starting, I would like to also encourage all the attendees to take the CFA. I'm not sure if probably some of you already took a level 1 or maybe level 2. I don't know, but I highly encourage you to pursue the CFA program until the end. And but I also would like to highlight that if you already passed the level 1, you can become a member of the CFA Institute and also of societies, of local societies such as ours, such as the CFA Society Portugal. And I think, from my personal opinion, and I think many people share this opinion, it's an amazing way not only to learn but also to network, because you have access to events that are like this, in which you have access to information, but you also have access to events, both physically and online, and you actually can meet people. So it's an amazing way for you to learn and make connections within the financial industry. So let's start. Let me first introduce all the 3 guests. I would start with Luís Alvarenga. Luís Alvarenga is a portfolio manager at BPI Gestão de Ativos. He has 17 years of experience in portfolio management, having worked priorly to BPI at Banif and Caixa Geral de Depósitos. Luís holds a business degree from Universidade Nova, and he is a CFA. Next, we have Diogo Pimentel, who is an investment analyst at Magallanes Value Investors. He works out of Madrid. He has 16 years of experience in portfolio management, having worked as well at Santander and BPI. He studied electrical engineer at the university at Instituto Superior Técnico, and he's also a CFA, Chartered Financial Analyst. Finally, Ricardo Seabra is a portfolio manager at BIG. He has 16 years of experience in portfolio management, trading, and financial advisory, all of which at BIG. And he's also a columnist for the Portuguese newspaper Sol, and a commentator for the TV broadcaster at TV. He holds an economic degree from Universidade Nova, and he's also a CFA. So, introductions made. I would start with the most philosophical question, and I would ask all of you, what is portfolio management? Who wants to start? Luís, Diogo, Ricardo? Who wants to explain what portfolio management is?
Thank you for the introduction. If the other guests don't mind, I'll take the lead here. Just to say that it's a very broad question, and portfolio management can mean a lot of different things. I think, especially nowadays, we're coming out of a more typical low inflation regime, which created a lot of opportunities for more traditional 60-40 portfolios. in the current environment, an alternatives portfolio management is becoming ever more in demand. So the management, the question is, what is portfolio management? I would probably say that the guiding thread between all of those approaches, which are very different in terms of opportunity detection, is you are essentially a risk manager. Your main function is to determine and select investments that are according to your investment mandate that have a greater expected return than the risk you're taking. So at the end of the day, I'd say the most important skill for that would be to be very good in terms of assessing risk. And I wait to see if the other guests agree with me or if they have a different take.
Yo, you want to say something?
No, I totally agree with what Ricardo just said. It's of course a broad question. I would say that in a more generic definition of portfolio management is the work by a portfolio manager to outperform inflation. But at the end of the day, what you want with your investments, your final goal is to maintain your acquiring power. So you have to outperform inflation, and that can be done with several asset classes and several ways, active investing, passive investing, you name it. So I think in a broad way, that's I think the main goal is to maintain the acquiring power of your savings, right?
So my turn. Hi everyone. Well, obviously I agree with what was said. Let me just add a couple of things here. First, I mean, I think as a portfolio manager, one of the questions I have to ask myself every day is, do I have a portfolio that, in my opinion, and that means that I can be right or wrong, but in my opinion, is trying to maximize risk return. I think that's a very important part. So you can have stock ideas, you can have bond ideas, you can have asset class ideas, but at the end of the day, is this portfolio maximizing risk return? Now, we know, and it's the way the game is played. There are restrictions. Sometimes those restrictions come from regulation. Sometimes restrictions come from your clients, and that's something that you have to embed in the portfolio, in your model, and you have to accept those restrictions and make sure you comply with them. And lastly, there are frictions in the market. Sometimes there are things you cannot do for whatever reason. It's not worth doing that, and that also has an impact. So I think these are a couple of things that we have to think about every day. Sometimes we think more on one than the other. But lastly, I think that also an important part, and perhaps increasingly important, is communication. As a portfolio manager, it's important to be able to communicate the portfolio, your decisions, being transparent, being able to explain what you have and the decisions you took. So I think these are the what I would characterize as portfolio management.
Well, can I do a follow-up question? When you say explain and communicate, you're talking about communicating to clients or within the team? What do you mean exactly by that?
Everyone. I mean, everyone. Sometimes you need to explain to the end client. Sometimes you need to explain to sales. When things go south, sometimes you need to explain your boss. That's also part of the game. And also you need to convince your teammates, right? I mean, you're this is a team player job. I think that's everyone, or at least a huge majority of decisions are done collectively, and you have to convince your team that this decision you're making is the right one for whatever reason, and make them be on board. Because when things are easy, everyone wants to join the team. When things are not that easy, I think it's a good idea that you have everyone buying your investment case. So I think that it's a very broad definition of communication, but I think it's a very important skill. And at the end of the day, I think it comes down to transparency. So being very transparent, explain things. I think in the long run, that's an important part of being a good portfolio manager. Okay.
The next question would be, could all of you could explain a little bit what your investment strategy is, or constraints that you have in the way you have to invest, in how you make decisions. Ricardo, you want to start?
Okay, so we're keeping the order. Okay. Yes, I totally agree with what was said so far. I think Luís's final comments were quite on the mark, and especially something that the CFA program really hammers home in terms of transparency, ethics. After the subprime crisis, that became very obvious that the financial world badly needed a boost in terms of ethics, and I think the CFA program is also very competent in driving that home. In terms of your question, so I probably have the more niche strategy here, but I'll try to describe it. So I manage an alternative macro hedge fund. It's a macro diversified hedge fund, which is the flagship hedge fund for Banco de Investimento Global. We started this strategy as part of some satellite portfolios when I was one of the traders in the Banco BIG's treasury desk, which of course the bank's balance sheet was mainly managed in terms of bonds. But on the side, we were experimenting some uncorrelated strategies with those more traditional assets, and we arrived at a strategy that tries to be almost an all-weather strategy. Because we use futures to obtain our exposures in the markets. Futures is a very efficient instrument to gain exposure to very different asset classes, and we try to blend the 6 asset classes that the futures market allows us to trade. So the 3 strands of commodities, agriculturals, metals, and energies, and then we join equity indices, bonds, of course, bond futures, and we join interest rates. And our goal here, we have 2 different components to obtain, to basically detect our opportunities. One is a pure price-based trend model, which basically we fine-tune every day, and every week we update the model to see if there are new trends, both on the upside or on the downside, and we try to follow those trends for as long as they take hold in terms of pricing momentum dynamics. So we have a more momentum side on one side of the strategy, and that is great when it works very, very well when the market has a very assertive economic paradigm, which then feeds into a very assertive financial asset paradigm where prices tend to trend a lot. And especially interesting for those trends is the commodities and FX space. And then on the other side, we have a more, maybe more intuitive, typical fundamental side, where we blend a rules-based optimization system. So we use asset causality in the past together with economic theory. What would you expect if, for example, a country is growing? And a very simple basis, you expect its equity markets to go up, maybe its interest rates also be going up, and it's depending on the characteristics of the market, the FX can go either way. So we have a model that optimizes that for different market scenarios, and we refresh that on a monthly basis to obtain fundamentally based ideas. Over that, and of course these more systematic elements work better. They're more medium to long-term sighted investments, and of course to manage a bit of the short-term volatility, especially around what we call very important events, like for example, the central bank meetings are of the essence these days. Inflation, economic data is also very important. Also, political events in main geographies. We have a slice of the portfolio that is dedicated to tactical asset allocation, and so we use that opportunistically to maybe hedge out some exposures before these high volatility events. These are the components that lead our opportunity detection system. Then the most important element is this. Imagine this as the branches of a tree, and then the main part, the tree trunk, is our risk management system. And because we deal with very different assets, like for example, we might be trading, for example, soybeans together with the short in German interest rates, together with the China equity index, just for you to know, these are very different creatures. And so how do we bring them together in what we consider a balanced portfolio? We always balance these assets and we standardize by their volatility, i.e. their inherent risk. So of course, the more risky asset classes, precise assets to be more specific, will have, the more risky will have a smaller weighting than the less risky. And I won't get deeper into that analysis, but we of course volatility weighted, and then we have a minimum correlation filter. So basically we're trying to diversify between different drivers and not necessarily different assets. Sometimes assets correlate a lot, and that means that they are reacting to the same driver. We have, after our volatility weighting, we put the would-be portfolio through a minimum correlation filter. And this, at the end of the day, will give us continually least correlated portfolio, which in our view will give you the maximum diversification possible. And this is what our mandate really is: provide a very good, very resilient reward to risk, basically, by diversifying among the most macro drivers possible. And so I hope, in a nutshell, I managed to describe what is an alternative and somewhat sophisticated investment strategy based on derivatives, as I told you.
Thank you, Ricardo. Luís, Diogo wants to go next.
I can go next. So in Magallanes, we have a more traditional approach, or a more plain vanilla approach to investments. We are an independent asset manager. It was founded by Ivan Martin. Ivan Martin was my boss. He was the head of equities in Santander at my time in Santander here in Madrid, and then we moved on to this independent asset manager. And and we're doing basically the same that we were doing in Santander, but the biggest difference is in terms of the pressure that we have and the capacity to invest with a long-term horizon. That's for us paramount, and that's the biggest difference we found when we were at the previous roles. I was in BPI and Santander. Also, it's the pressure that you have in a retail, typical retail bank like Santander. You have the pressure. Your results are measured, if not every month, but are measured every 3 months. And if you have an asset class like pure equity funds like ourselves, it doesn't make any sense. You have to invest for the long term. You have to invest with the long term view. You don't buy an equity fund or even a share of a company with an horizon of 1 year, and no one knows what's going to happen in 1 year. You have to be humble and to know and to recognize that it's impossible to invest in 1 year time view. So what we recommend to our clients is to invest with a typical 5 to 7 years horizon, and that's what we do. And that's what we found that we have in Magallanes. We have this philosophy. Our clients understand it, and they are with us, and they don't ask what the market is going to do next month, or they don't complain if the market goes down 20% in a couple of months. So we have equity funds. We are focused in Europe. We just have plain vanilla funds. We don't do any kind of derivatives. We don't do any kind of short positions. It's long only. Focus on Europe. We have 3 strategies: 1 European fund, 1 Iberian fund, and 1 microcap fund. But the majority of our assets under management are in the European fund. It's around 85% of our AUMs, and we are managing 2.1 billion assets under management, and we've started for a company that was founded at the end of 2014, and since then we have very good results. We have a compound average rate since the beginning of 8%, a little bit above 8% a year, and it was achieved in the very difficult environment for European equities, and especially for value investing. We are value investors, so we focus on the fundamentals of the companies, and so we have an owner's mind in approach to investors. So it's more like a private equity. When we buy a stake in a company, we know we are minority shareholders. We have to trust on the management team, and we're going to be there. We're going to be partners in this journey for the next 5 to 7 years. So it's a fundamental business. We like to buy companies at cheap valuations, but good businesses. We have to understand how the business makes money. That's paramount for us. We have to understand, and then after that, you have to understand the management team. What's the competitive position? What's their competitors? Who are the best companies? Is it easy to replicate? Is it easy to destroy or to hit this kind of business? How is the balance sheet? We are extremely conservative in terms of analyzing the balance sheet of our companies, because in our track record, the bad news or the negative surprises always came from the balance sheet, not so much from the competition or from the macro environment. And that's what we do. And we have very concentrated portfolios in our European fund. We have typically 30 to 35 names, so that would give you around 3.5% weight for each position. So we want to be concentrated. So we have to know a lot from the companies, and we know a lot from the companies by visiting the companies, talking to the management teams, talking to their competitors, visiting the companies, and that's what we do. We don't aspire to know every company on the European market. We don't, because that would be impossible. It'd be unrealistic. We don't aspire to know every sector. We know what's our circle of competences, and we don't go out of our circle of competence. There's several sectors, biotech, startups, technology that we don't look, and we don't mind. We don't want to follow the benchmark. We don't care. I don't know what's the weight of the financials, the banking, or the energy in the European benchmark. The benchmark is a reference in performance. I think it's very important, so our clients know if we're doing or not a good job. But I don't care. I don't follow if the weight of the financial sector is 20%. I have to have 20% on the financials. It doesn't make any sense. On our point of view, we have to buy businesses that we understand and we think they are undervalued, and it will generate a lot of value for the next 5 or 7 years. That's our investment horizon.
Oh, great. Actually, it's quite curious. Very different strategies and approaches. Actually, one question. Is there any company that you end up having a large position and in the point that you can influence the management, or you only stay with very small positions?
No, that's a good point, because of course, that's a broad question and generic. First of all, in terms of our approach, we are more focused on the mid and small cap companies. So up to 10 billion, it's the universe that we find that it's more easy for us to create value. Of course, if you are following Louis Vuitton or Total, you have 50 analysts looking at the company. Everyone is looking. It's much more difficult to add something there. And if you're going down to the small or the mid cap space, it's easier to get. There's a lot of companies with no coverage or less coverage. So in that space, we can have relevant stakes. For instance, in several companies in Portugal, Spain, we are reference shareholders, like the case of in the past in Sonai, we had more than 2% of the company we sold. Nowadays, for instance, we have more than 5% of the Ibersol here, and in the European space, we have several companies 1-2% stake. And regarding to the engagement with the management team, that's a very good question. It's when we start at the beginning of a company, of course we talk to the management, but we don't want to be an activist, a typical activist investor, right? We don't want to invest in a bad business and say to the management team what they have to do. No, we invest. One of the things that we like is the management teams. We just invest in a company where in the investment, when the management team track record is very good. So it's one of the things that we want, and we want to have protection. We don't want to be a private equity to hold a stake and to go to the boards and to management. But of course, sometimes things turn south and everything, or there's a management change, or there's a strategic change on a company, or a new shareholder, a big shareholder with demanding changes. And of course, we have to engage, we have to do our work, we have to go there to be more active, more vocals. For instance, in the case of CTT in Portugal, we were very vocal there. At one point we had more than 5% of the company, and we didn't like how the strategy of the management, what they were doing, and we partnered with several other relevant shareholders of the company. We discussed ideas, how can they improve, but we do this, but that's not our typical investment. In the typical investment, we want to trust on the management teams, we want to trust on the track record, and we want to be partners in this journey.
Interesting. Nice. Luís, your turn.
No, I'm going to make this really simple. So I have in my team, I have equity portfolios, I have multi-asset class portfolios, and I have bond portfolios. And I'll just take you through some of the principles we have in terms of building equity strategies. Listen, I think it's very important to recognize that the market is extremely competitive. Okay, I think I think we all recognize it's very difficult to beat the market. Sometimes I say that sometimes Portuguese teams play in the Champions League. I mean, we play in the Champions League every day, right? I mean, we play against the biggest companies. We trade against them. So we play in the Champions League every day, every second of the year. So I think that's something that's very, very important input into our strategy. The second is avoid mistakes. Now, if there's something you don't know how to do it, you don't have a clear competitive advantage, don't make that bet. That's something you don't have to do. And thirdly, stay liquid, stay diversified. I mean, the worst thing is to be a forced seller, and it's very important to avoid over concentration. Most of the downfalls I've seen in portfolios in my investment career have been portfolios that have been very concentrated, and for whatever reason that trade just went sour. So I think these are three important principles that we have in our equity exposure. So how do we build portfolios? I mean, we go through a quant process. I'm not going to bore you with that. Just the idea here is to identify the best business models in the world. Now, what does that mean? Business models in the world. It means companies that are highly profitable, that are very stable in their cash flow profile, in their margins. Okay, and basically what we want to identify is the companies that have a very strong, sustained competitive advantages. Now, we want to invest in those companies and hold them forever. Okay, I know that forever is a very long word, but that's the basic idea. Now, part of the magic, the special sauce here is how to build those companies, those great businesses, into a diversified portfolio. So we use risk factor controls. We use tracking error. We use, some more sophisticated, less sophisticated techniques, and that's basically it. I mean, with some more with a greater or lesser degree of complexity. That's what we do on our equity buckets. Now, on the bond side, we've also developed a model, a quant model, that basically there are a lot of bonds out there, and we screen them every day, and we look for where are the opportunities. And what are opportunities for us? We want to get the best spread per unit of risk. We define risk. spread is very easy to see, and so we know what we want to buy, we know what we want to sell. We try to get some market confirmations from that, so we look to cross markets, we look to equities, we look to other instruments to see if our assessment of the pricing of a bond is correct or not. And then the last part of our bond strategy is to try to find the best prices in execution. So we have developed a series of techniques for that, and that's basically it. Listen, this isn't that complicated. I think that's one important thing here, is that nowadays it implies a certain degree of data science, okay, in the sense that there's a lot of information, there's a lot of rows, there are a lot of columns in our spreadsheets, and I mean, more and more the people that we hire are people that have these the ability to do some programming. I think that's an important skill today and for the future. But these are the principles, these are the things that guide our portfolios, and that's what we try to, I mean, do every day on a sustainable basis. Okay.
Thank you. One question, you're mentioning that you are in the Champions League. You're saying that because you are basically choosing assets within a global or a European, at least European environments. That's the reason why, and you're comparing yourself.
No, I mean, Champions League in the sense that we are all participants. Ricardo, Diogo, myself, PPI. I mean, we are all participate in global markets, right? So
yeah.
I mean, when we buy something, it could be Goldman Sachs selling, it could be BlackRock, it could be I mean, some retail guy from Indonesia, I don't know, but we are all participate in the global market that is extremely competitive. That's why it's so difficult to beat benchmarks, and that's one of the reasons why passive investing has been a growing trend. Is because the market is I think this is fairly factual. I mean, it's a fact that it's difficult to beat the market. So I think that's why the analogy of the Champions League.
Okay, got it. If I can make a comment, even though I'm a moderator, I have a friend that he works as a portfolio manager in Brazil. He's Brazilian, and it's actually, we're talking about the differences in the markets, and it's very different because they live in such a large country that the large majority of the equity investors invest only in Brazil. So they are competing with each other, and they have a strong competitive advantage in comparison to the foreigners, because the foreigners sometimes don't even know the language, don't know the market. So the impression, even though I never did portfolio management, but the impression that I have in Portugal is that you basically are an European player, because you don't invest only in Portugal because the market is too small. You invest in Europe, and so it's quite different mindset and competitive environment.
Yeah, I just want to add that I think that also an important part there is the culture of the company. So I mean, your investment strategy is very much restricted, conditioned by the investment culture within your firm. So you can only be a value investor if you are in a firm that the environment is conducive to those to such strategy. I think that this is not it doesn't have to be like that, but I think it's also an important part of being able to set up a strategy in a given firm, the culture of the firm.
Okay. Which recommendations would you give to a student from the university who wants to pursue a career in portfolio management? Can he do portfolio management right after school? Is there any advice that you give to him? Ricardo, if you can keep the order.
I mean, there are no restrictions to be a portfolio manager. I mean, you cannot have a degree and be a portfolio manager. I mean, you can be your own portfolio manager. I think that's part of the question. There are really no restrictions. If you follow a more traditional career path, of course, I would say usually you don't start as a main portfolio manager. Maybe you might be selected to be an assistant portfolio manager, where you maybe you support a more senior portfolio manager. You take care of more of the operational duties. you also participate in discussions in terms of investment ideas, but ultimately maybe you don't have the power to make the final decision to invest or not invest, but you will definitely have an input. And I think it was Luís at the beginning that was underlining the importance of team play in this arena. I think the importance here is because you need to understand that maybe the best traders have like a win to loss ratio of maybe 70%, even as low as 60%. So this means that it's a highly variable arena. There's a lot of curveballs. No one dominates all the variables that are involved. So you always have to create what Ray Dalio puts very well as an idea meritocracy, where you have to have different views, challenging each other, stress testing each other, and then at the end of the day, you arrive at a consensus, more or less a consensus decision, or at least you understand that the flaws and the risks you are taking in taking a certain path if someone argued against that path, let's say. So, and the skills that you should develop if you have the ambition to become a portfolio manager. I think it's important. I think emotional intelligence is highly underrated in this arena, and this is where I feel most people fail. There's this market adage that says that only 5% of people in the markets actually make consistent money, and I think if it is true, that statistic, it's down to not because people are not intelligent enough, which I think this market is full of intelligent people. The issue here is that most of them maybe have not mastered their own emotions. The market, managing your money, managing other people's money, really really stokes your emotions, both on the euphoria side or both on the fear side. And you must learn. I think it's important for you to understand where your triggers are. And the triggers might even be biological. I mean, the most famous investors, like for example George Soros, said that before he put on the trade, if he knew it was the right trade because he felt like a funny feeling in his gut. So I think it's important, and it's maybe a bit esoteric me saying this, it's important to know yourself and where your emotional triggers are. Again, a lot of that is the behavioral biases that we all have. And again, the CFA program has a lot of literature on that, which is extremely interesting. And then on top of that, I put that number one, because that will feed a lot into your risk management capabilities. On top of that, just start following the market, start reading about how the economic and the political machine work around the world, and try to see what's happening in the news and see what are the reactions of asset markets. Try to start making a journal, a link between the two things, because the link might not be obvious sometimes, because in the middle of that you have the perceptions of every market participant. At the end of the day, maybe it's more like playing poker in the Champions League, as Luís was saying, than anything else. And I'll end with this point. Try to find a strategy that has to do with you. For example, I really value all the approaches that both Luís and Diogo described here. I think they're all very complementary, and it's a good panel we have here because of that complementary nature we all have. But it's important. For example, I couldn't do what Diogo does because it's just not. I'm not a balance sheet guy. I'm a macro guy, and I like to think things from a top-down perspective. So this is the niche that has more to do with my personality, and where I feel more enticed to learn and to be better every day. Coincidentally, my co-founder at our fund has a totally different mindset from me. So that's what makes our team great, having different mindsets together. But to hammer home this point, try to find your own niche in terms of asset class, in terms of if it's long only, if it's long short. Try to find what makes you tick and try to be better every day at it.
Okay, do you have any additional tip, or did Ricardo cover it all? Diogo, or first you?
I think Ricardo explained it really well. I think I'll just add that this is one of those jobs that experience it really works a lot. So it's having a track record, seeing years and years of the behavior of the markets or behavior of companies. It helps a lot. Every year you'll be a better portfolio manager. So on that sense, of course, it's very difficult if you go out of the university of college and go directly to be a PM, right? I think it's, first of all, as Ricardo was saying, you have to love what you do. You have to love what you're doing, and if that's what's happening, you'll be motivated to continue to learn more, to research more about what you're doing. But at the beginning, you'll start by the base, right? You'll start with I would say the less interesting jobs, but it is what it is. It is portfolio management, is in consultancy or in audit, right? And you're going to develop your skills, and you'll start. Maybe you'll start with an analyst in a junior analyst on a fund. You'll join our sell side analyst, and then you'll taking more responsibilities with time. Will be capable of taking more decisions first, and maybe then you'll be an assistant portfolio management. Then you'll have a small portfolio to manage it. I think that's the basic steps that everyone did, and it's a never-ending job, and every day it's different. I think that's one of the things that is very stimulating about this job. You have an infinite amount of information available to you every day, so you have to define your path. It's macro, it's bottom up. If it's bonds, stocks, commodities, you have to see, and all these strategies that me, Luis, or Ricardo have described, it's not mutually exclusive. Quite the opposite. If you have a portfolio, you should be diversified. I would never say that you should be 100% invested in a value and just in value or just in Magallanes. It's not our recommendation. You should be diversified according to your risk profile, your return goals, and that's very important. And as an analyst, then you have to develop. For instance, I studied engineering. When I was out of the college, I didn't know anything about business administration or economy or so on. I had a signature, a 6-month signature with the basics of everything. So I didn't know anything, and I was hired for BPI as a quant profile. I was hired to do models, and after 6 months, I saw that that's not what I do. I respect a lot with the quant models. There are huge quantitative funds. One of the best hedge funds in the world, Medallion, is a pure quantitative fund, and these guys are amazing. But that's not what I like to do, and that's I've drilled my own way. That's why I decided to do the CFA, because I needed the basics, and then the three levels were amazing for us. It were more than enough for me to give me all the background, all the tools to be at the time an analyst. And then after that, through my work and looking at companies, I live what I do. I end up being a value investor. For me, it's what makes sense in terms of my personality. And just to finish, I would the recommendation I would give, it's in terms of IQ. It's not your brain the most important organ when you're going to invest. It's your stomach. It's being able to have the temper to go when the market goes against you, right? Don't panic if you really trust what the analysis, what you've done, the valuation that you've done. If the stock keeps going down, if nothing fundamental is changed, you have to take the opportunity, like the Warren Buffett always said the Mr. Market is crazy. He's a maniac, depressive guy that sometimes is telling you that this stock is worth 60, and 3 months later he's telling that is worth 20, and it's the same stock. So you have to have the temper to understand that maybe at 20, if you know that the stock is worth 100, you have to buy it and crazy. And if you bought it at 40 and then the stock is going down at 20, so your margin of safety is even higher, your upside is even higher, so you have to keep buying. And of course you have to be humble when you make a mistake, because everyone makes a mistake. Peter Lynch, one of the investors that has one of the best track records in terms of value investors, with this Magellan fund in Fidelity, he used to say that the hit ratio in this case is 60-40. So but when he hits in the 60s, he was going to triple or 10 bagger company, and when he loses, he doesn't lose a much. It's not a permanent loss. So that's what I would say, that you have to be the temper, and then don't think that you need a huge IQ to be an investor.
Okay, thank you. Luís, before passing the word to you, I think Ricardo has to leave in a couple of minutes, right? Is that it? So before you leave, just want to say a few words why everyone should take the CFA before I let you leave.
I think I already left a few clues along this panel, and also picking up something Diogo underlined about the program, especially for him, that I don't think he came from an economics degree, so especially useful for situations like that. But even for me, that I came from an economics degree, something that apart from those situations that we already talked about in terms of the ethics component that you should not ignore, also in terms of a good literature in the behavioral biases domain, to get to know a bit about what are the common triggers, both on the upside or the downside, in terms of how we perceive things, which is very important in the investment landscape. But on the whole, I just felt the program was very holistic in terms of giving me a broad picture and plugging in any holes that I would have in terms of the connection between economics, risk management, portfolio management. I think it's a very complete program. It's definitely, I already had a very good basis because of my economics background, and also because I started trading quite early. But the CFA programs helped me a lot throughout the 3 levels to, number one, really test my discipline, and discipline is probably the most important skill in terms of risk management. I mean, discipline is risk management, and vice versa. So the grit that you need to go through those 3 kind of very challenging years is a skill that will stay with you for a lifetime. And also, and then in terms of the actual knowledge that I acquired, it's helped me, even coming from a very complete background already, to plug in a lot of holes. And by the end of the day, when I finished the program and managed to acquire my charter holder, I really felt much more confident about my ability to link all the topics together. And I think that is something very important, to be able to link the several cogs that make up this investment machine. And with that, I leave you. Thank you so much for having me. I'm off to check the meeting of the Federal Reserve. Thank you, Diogo and Luís. It's been a pleasure to share the floor with you. Goodbye, everyone.
Bye. Thank you, Ricardo. Back to you, Luís. What tips would you give to anyone who wants to pursue a career in portfolio management? If you have anything to add beyond what was already said, or otherwise
no, I think there aren't big secrets here, right? I mean, I think that one. I think it's important to really love this. I think it's a demanding job. It's a job where learning, reading has to be part of your daily routines. Okay, and I don't mean just office hours. I mean, you go home, and sometimes you find yourself at 10 in the evening reading some article that someone sent you. And I think that's part of it. So you'll have to accept, and maybe your wife or husband will not fully understand, but it's part of it. No, I think there's no big secrets there, to be honest. Just enjoying reading a lot and make the most out of it. Yeah.
Okay, thank you.
On your previous question, I just wanted to add something that real quick. That I mean, coming from school and being a portfolio manager, I don't see anything wrong per se. I would just say that when things are difficult, when you lose money, and I'm talking about other people's money, of course, you start, there's a different chemistry inside your body. Okay, things start to change. Adrenaline increases. Sometimes you sweat. Okay, sometimes you go to the bathroom more often. Okay, these are normal symptoms, and they happen to everyone. So when it first happens to you, just accept it. It's normal. And living through those moments like 2008, 2011, I mean, Brexit, those times where there was really some panic out there. I mean, when in March 2020, I mean, it's really a valuable experience. It will make a difference going forward. And not having that experience, I think it's something that it's something that really lacks. But that's something that you can only improve and get in your toolbox with time. So it's just a thought that I think when the butterflies happening, it starts to fly in your stomach. It's know how to act, know how to behave, making the right decisions. Sometimes making no decisions. That's something that experience does play a hand there.
Would you say it's a stressful job, or it's especially stressful, or it's only stressful when the market is going strongly down, or is it, generally speaking?
No, I think there are different moments. Obviously, when markets are going down, things are more difficult because you have more inquiries, right? So everyone wants to ask why, what have you done, why am I losing money? So these questions come about very very often. And obviously, I think experience helps to organize yourself and organize your mind. I think also it's important to come home at the end of the day and I mean stop thinking about it a little bit, to try to separate things. I think that's an important part of mental health. I think that's something that you should try to do. I don't know, have some sports, have kids, whatever that make your mind get away a little bit from that. But then there are moments in time when you have a new product, when a given strategy is not working particularly well, that can always also be stressful. So I think that, like every job, I'm sure that for people that drive trains, there are also stressful moments, and in this job as well there are stressful moments. It's important to learn how to live with that and manage those emotions. I think that Ricardo touched a little bit upon that. I think that's really important to survive and to do well in this job.
Perfect. One question: how did the portfolio management profession change over the past years, past couple of decades, with the growth of passive management? We also because of the crisis that you mentioned, 2009, then the low interest rates, the boom in the stock market, and now the recent the 2022 fall. How do you would comment the way your profession changed over the past couple of decades, or since you started your career?
I'll change the order, and very quickly I'll just highlight one thing that I think that really made a big difference. It's technology. Okay, from my side, I think that technology played a huge hand on how the job changed. I mean, I mean, when I started, there was already Bloomberg. So I guess people that started working before Bloomberg or Reuters or whatever, these new softwares, I think that was a huge difference. No, but when I started, there was already a Bloomberg. So it's not so much that, it's the evolution within already a given level of technology. So the platform has improved massively. Portfolio construction, risk analysis has improved massively. More recently, enhancements in terms of sustainability, ESG, all those topics. I think that that makes a huge difference. I mean, you can process a lot more information, get a lot more information, get a lot more outcomes. And so you have, what's the big difference there? You have a lot more data points to get information and make your own decisions in a more informed way. Making mistakes is part of the travel, right? I mean, it's going to happen, but having the best data points and a lot of data points to make that decision, I think that's crucial. That's what we try to do here as well. And I would say that that's the biggest difference I see from any others, obviously, but the biggest difference I see in the last 15 years or so.
Okay. Joe, do you have something to add regarding this question?
No, technology, of course, it's the biggest point. The only thing I would add to what Luís said is in terms of the access to information. Now you have almost excess information, right? We live in an era of overstimulation, and I think we as value investors, we think it's too much. We don't move. Our annual rotation of the portfolio is 10%. So we have 30 to 35 companies in the main fund. So on average, we change 3 to 4 positions a year. So, and we have constant overstimulation, a lot of noise, a lot of mails. My mailbox is full. I don't know, 1,000 mails a day. It's too much. You don't need so much information. You don't need. I think that's changed a lot for the worst. I think in terms of course, technology brought. It's 50 years ago. If you want to have an annual report, you had to write to the company, wait this annual report to be sent by mail or go to the library. See you have these big S&P books that would make S&P famous with annual reports of all the companies, and that's now it's instantaneously, right? The company reports and then you have it on your mailbox. This changed a lot. This asymmetry of information now is much more plain vanilla, especially if you go to the big companies, the large caps. But in the case of small and mid caps, there continues to be some degree of asymmetry in terms of the information, and that you can create a value. But in terms of when a company doesn't change so much as the share price looks at it, right? And that gives you a lot of opportunities if you are a long-term investor, if you have liquidity, if you have the capacity to wait, and you just have to wait. This volatility, this market volatility generates a lot of opportunity. Then I was going to just answer about the passive investing. That's one of the things that always we are asked this. It's our job going to disappear in a world of ETFs and so on. And I think no, it's quite the opposite. I think we are very happy that the ETFs have starting to appear and to gain market share, because they have came to show the market one thing that was what is called closed indexing, right? We have a lot of these big asset gatherers and big asset managers. I don't want to put any names on it, that had these huge equity funds that replicated the indexes, and they charged 2% commission, and with no value added. Of course, if you charge 2% commission and you replicate the index, at the best you are going to lose 2% a year against the benchmark, and that's why these products are being killed. It's not the good portfolio managers, the good ones that are able to generate value in the long term. They are very happy with this. They will continue to generate a lot of value, because an ETF from the conceptual point of view, doesn't make any sense, right? It has makes sense because it's a cheap way of investing. So if you want to have exposure to the equity markets and you don't have time to select a good portfolio manager, it's the low cost solution. But of course, it's a low cost because it doesn't make any sense. It's a computer that buys all the stocks in an index. But does it make sense to buy all the stocks in an index? Or are all the stocks worth having them? Are all the stocks cheap to buy them? No, of course not. So there's this asymmetry that doesn't make any sense. And so if you are an active manager like ourselves, we think we can create a lot of value in the long run. Of course, you're not able to beat the benchmark every single year, of course, but in the long run, if you wait this 5 to 7 years investment horizon, you're going to outperform the benchmark. We don't have any doubt of it, and we've done it since we've started 7 years ago. We are up 8% a year, and the benchmark is 5% a year. So we have outperformed three percentage points every year. So, but was this a linear 3% every year? No, of course not. There are years that we were behind the benchmark, and there are years like this one where we are outperforming by 15 percentage points. So that's what we think. I think the ETFs and the passive investing were very useful tools to end up or to put a more difficult life for this closed indexing.
Quite interesting. Okay. We're running out of time. Actually, we are already past time. Time flies. I will just try to finish. If you have a few more minutes, Diogo and Luís, could you tell how did the CFA help you in your career, and why you would recommend all the students that are watching to take the CFA?
Well, I'll start. No, for me personally, it was a fantastic experience all around. It wasn't just the learning; it was the whole thing, the whole package. I loved it and still do. Well, first of all, it was I mean, it was doing the CFA while being a practitioner. That was of huge value to me. So I was reading things, and I was thinking, man, I could really use this. So this is a different angle that I never thought about it, and perhaps I should try. Or you seen something and you see, well, I did this mistake. Try not to make it again. So these were a lot of the thoughts that I was having while being a practitioner and reading and going through the books. Then I was lucky enough to have a few people a few persons, colleagues of mine that were CFAs, so they helped me. So I had a lot of teaching, a lot of good interactions that I think that helped me to push forward and continue, move on, and improve my learning. And then the networking. I think that I mean, being a CFA, obviously, I think it's a quality stamp, you know, and everywhere you go in the world, I mean, it's a recognized brand, and I think that's a huge plus. I mean, particularly for someone that really wants to do a career in capital markets, but in finance in general, I think it's a very well recognized brand that will stay in your CV. And the networking side, I mean, a lot of the people that do CFAs, they want to stay in the job, they want to stay in this industry, and that helps to build relationships. Sometimes it helps to move to other companies, other sides of the business. So I think it's a very, very strong experience that goes a little bit further than just the learning bit. And then there's always the continuous learning. I mean, the last big trend has been the sustainability topic. I think that CFA has also tried to capture that and play a leading role there. And I think it's been helpful. And so it's not just you do the exam and it's done. It's the networking, it's the continuous learning. It's a big plus. So I strongly endorse and support everyone to go through with it if you're really serious and want to excel in this job.
Thank you. Diogo, anything to add just to finish it up?
From the academic point of view, I have nothing to add. I think Luís and Ricardo explained very well. I think I tried to explain also very well from a guy outside the economy of finance. I would just add in terms of in international career, right? If you want to have an international career, the CFA is a certification that everyone knows in Europe, in the US. It's an easy, if you want, I don't know if you guys are from Catholic and Nova or which university or for technical. If you're going to talk to an hedge fund guy in London, he probably doesn't know that university, or even the HICADE here in Madrid, which is the best finance school. They don't know, but if they saw in your curriculum this CFA, they know it's a certification, international certification, a well-known certification, and when you start to look to jobs in some years' time, you will see that in many in the from what I've seen, the asset management business, they put the CFA at the same level of the MBA. The requirements for job, it's a CFA or an MBA. So in terms of value for money, if you are a cheap guy or a value investor like you, like myself, it makes a lot of sense, and much more sense to do a CFA, because it's much more cheaper, it's much more comprehensive, and you, at the end of the day, you'll be at the same level of the guy that invested a couple of years and 1,000 and 100,000 euros or on an MBA, and you'll be at the same level. And so I think value for money, it makes a lot of sense, apart from all the academic benefits that we've highlighted here.
Great, thank you, Luís, Diogo. I really thank for you guys having come to become a speaker at this event. Again, I would like to thank all the attendees, all the universities. We'll have another one of these events next month. We'll announce it anytime soon in the coming days, and I hope you guys join us again. Thank you all.
Okay, thank you very much, everyone. It was a pleasure.
Bye, everyone. Take care.
Thank you.
Bye.